All right, what is up, everybody? It is a beautiful Thursday, I think, afternoon. We are joined today by Steve and Amy Knirsch, and Steve and Amy are back to teach us more about under 65 health insurance, how to package, how to get more out of every appointment, which is what we all really want to know. So without further ado, Steve, Amy, take it away.
Thank you, Dallas.
Thank you.
Yes, sir.
All right, thanks for everybody for joining on here, and for those that will watch this later, we appreciate it. We're going to make sure that we know that the topics that we're going to be talking on today first. So today we're going to talk about what's available in the under 65 market, and then we're going to share what we call our Foursquare, and it's going to help us determine what product line a particular client might fit into. So we're going to talk about that. We're also in the next couple trainings, we're going to talk about cheat sheets and package plans, prepackaged plans, how we package them, how those are packaged together. Under 65 prospecting, we've kind of already gone over in another one, but product knowledge, we're going to talk about some products and get everybody up to speed on under 65 products. Then we're going to do some ACA quoting, which we kind of touched on in another one, and commissions as well, which we're going to kind of dribble out through all of these sessions. So I'm going to share my screen. We're going to get started with a little presentation that I have prepared. I think. All right. Can everybody see that okay?
Yep.
Good. Okay. All right. So the first thing is, where in today's world can you get under 65 health insurance? You can get it from a job-based plan. So if your employer offers group benefits, you can get it from there. If not, then you have the Affordable Care Act, health shared ministry plans, short-term medical plans, and fixed benefit plans. And those are your basic options on how to get health insurance in the under 65 market. Now, there are lots of different companies out there that offer all these plans, and some of them are mainstream companies, some of them are lesser known, but they're all out there, and we have through SIG the availability to pick up any of these contracts with any of these carriers. Within reason, you know, some of the small local regional carriers, maybe not so much. Some of them don't do business with brokers. They're only captive, or you have to call them direct. Other than that, we can get most anything. All right, let's go right to our Foursquare. This is how we're going to determine which medical plan to use. So let's go in the top left first. So top left says have money and good health. So you have cash, they can pay their premiums, and so we're not worried about budget, and they have good health. Okay, so anybody want to unmute and chime in what kind of products that would fit that category? Just about anything, right? Just about anything. You have money and you have good health, you can qualify for short-term medical underwriting questions. You can fixed benefit underwriting questions. You can pass underwriting. So you can pretty much get anything you want. And if you have the money, you can get an ACA plan if you need to, or if you really just want an ACA plan for whatever reason, and you can end up paying for it, and you don't have to worry about underwriting on that. So let's move to the right. Let's move over here to, we have money, but health is not so good. Anybody want to chime in on that one? Okay,
What do you mean by bad health? Determine that first.
Yeah, so bad health. This might be diabetic, right, on insulin. If you're diabetic and taking insulin, that would be something that would not pass medical underwriting for short-term medical or fixed benefit plans. Even health shared ministry plans may not like that too much. So that means that we have fewer options, and or there's a pending surgery, or there's a pending some kind of diagnosis that hasn't been completed yet, or you have multiple oral meds for diabetes, or just anything else that's an ongoing condition that might be on the medical underwriting list. So those are the bad health. That would be bad health. They have money, they can pay their premiums, so budget's not a concern, but they have bad health, right? So this might lead us to an ACA plan with health. Depending on what the conditions are, we might be able to work into something else, but ACA might be where we go with bad health.
So I think we want you to know that if they have truly bad health, they'll have to go to the marketplace. They have the money, they're not going to get a subsidy. Now, sometimes people think, well, bad health, if they have anything. So that's not the case. If it's a thyroid issue, blood pressure, cholesterol, kind of all, most everybody's on something like that. If it's under a maintenance condition, so like I have a thyroid issue, I take a med for years now, it's under control. So that's not in a carrier's definition of bad health where I would need to go to the marketplace. So that's where we want you to understand the difference between, really the definition, I guess you want to say, of bad health, what conditions fall in that, and when you need to go to ACA, or just because they have some of those routine things does not force them that way. It can open up some other options.
Absolutely. All right, so now we're going to go down to the lower left. So no money and good health. So good health, again, opens up all kinds of prospects, right? So all of the products, but no money is dependent upon how much no money is, right? So are we talking about they have a lower income, or they just have no money? So it's got to be somewhere between Medicaid, right, and where the Affordable Care Act picks up. And then after that, they might have enough money to get a short-term medical plan and pass medical underwriting. Just depends on how big of a package they can absorb, right? So maybe they're not in the market for dental, vision, hearing. Maybe they're not in the market for a critical illness plan, something like that. We would just peel it back to meet the budget, but they have the health to pass medical underwriting. So we would just do whatever's right and whatever keeps the most money in the client's pocket and the least amount of money going towards a provider or towards an insurance company.
And again, think of the no money as being relative. So
Right.
No money to somebody, their budget might be 500 for their family of 3 or 4. Another one might literally be $50. So for a family of 4. So that's a big difference. So you can, if it's $50, then, you're going to have to go to the marketplace for a subsidy. If it's 500, you again have some options. So just make sure when, our definition of no money may be very different than the client. So never assume that X is too much, because to them it may not be. Maybe they're paying, like I just talked to somebody the other day, $1,800 was their budget because they're paying more than that at their group plan. Well, that's a big freaking budget, right? For someone else, that would be like impossible. So just make sure that you're asking the questions on what budget they feel like they can handle each month. You're obviously going to be asking about adjusted gross income so that you can check for a subsidy, and that'll help you determine that part of it.
Yep. Absolutely. All right. And then the last one on the lower right, no money, bad health. So we're pretty much going to the Affordable Care Act here in most all cases. It just depends on the health, how bad is the health, and how little is the money. So that is a high propensity to go to the Affordable Care Act right there. So now I'll just throw this in, in today's world, there's more money coming out of the Affordable Care Act. It's going to be a bigger player in under 65 health insurance this year and probably next year. And until things change, or if things change, that's going to be a bigger player going forward. So we're probably always going to include an Affordable Care Act plan packaged in a presentation to a client. Any questions on this? Any questions on the Foursquare, how we determine where people go? We're good? All right. So now we're going to get into what we know what plans are available. We know what how we're going to where we're going to put these people, and then we're going to fill these holes. So all these plans have holes in them, whether it's a deductible, max out of pocket, co-pays, it could be cancer meds at some point, whatever, any out of pocket expense that's built into their medical plan. Those are all holes that we want to try to fill. So our job is important in packaging under 65 because 2/3 of the that file bankruptcy cite medical issues, and as a key contributor to their financial downfall. So people are filing bankruptcy over a small amount of money. I guess a small amount of money is relative to the person, but high cost of healthcare has historically been a trigger for bankruptcy filings. So all these things are leading people to a road that they don't want to travel on, and that's our job to help mitigate that. Most people don't realize that their health insurance may be not enough to protect them. So just the health plan alone, 66.5% of all bankruptcies are medical bill related. Most of those people had health insurance, they were just underinsured. 530,000 families turn to bankruptcy each year because of medical bills. Most families do not have enough money saved for a simple emergency, let alone $1,000 of unexpected medical costs. 40% of Americans have enough saved to cover $1,000 of medical emergency expense. Affordable Care Act. Okay, where are the holes in Affordable Care Act plans? They have small networks. So we have to be very careful that we understand and we communicate to the client that the network that they have on the Affordable Care Act is an HMO or an EPO or a PPO, and you have access to doctors in this area away from your house. So it may be the state, it might be more of a local region. You know, in the Kansas City area here, we have a number of counties that collectively are an in-network for one of the Blue Cross networks. And there's like 3 levels. You know, one of them is a few counties, and then it gets bigger up to like 13 counties. So we just have to be careful that we're putting, they have an idea of what their network looks like and how big it is. So if they go traveling across the country and they have a 13 county network in the Kansas City area, they might be in trouble.
The way that I try to explain the network issue is outside of the small local or regional network, you're not going to have any coverage unless it's life or limb. So you're literally dying or your limb is severed, about to fall off your body. Not like, hey, I'm, halfway across the state, I twisted my ankle. It's not broken. It's not falling off my body. It just hurts really bad. If they want to 100% sure have that covered in network, they need to make the painful drive back to Kansas City area in our example. Now, I will also say, so because most people are usually pretty surprised, like, holy cow, when I go on vacation to Florida, I don't have coverage. Yeah, you don't unless it's something major. Now, if you're on vacation, you're probably not going to the doctor unless something major happens, right? So you have a heart attack, whatever it is, get hurt really bad, whatever. So now those things are likely covered. Now, if it is like Little Johnny's ear is hurting and you go to the urgent care and he has an ear infection, that's not going to be covered, but it's probably not that expensive, you know, $100, $200, something like that. So is it that big of a deal? Maybe, maybe not, but you do need to point out that, let's say that you have a really bad stomach pains, you're doubled over and it's not getting better. You think maybe, what if it's appendicitis? And you end up going to the ER, they do a bunch of tests and determine there's really not anything. Maybe you had some bad sushi or bad Mexican or something. And now you've got $5,000 worth of bills, because we all know the ER and a few tests, you know, add up really quickly. Those kind of scenarios are where they're going to experience some, you know, high out-of-pocket cost. For us, we just want to make sure that people understand how their plans work and how they don't work, so when they go to use them, there's no surprises. Go ahead.
And put a good message in the chat, said you know, if you have an ACA plan and you're traveling somewhere outside of your network, use a travel plan. So you can definitely use a travel plan for the time period that you're gone out of your network.
Yes.
So that's definitely a good idea.
Excellent, Anne. Thank you.
Okay.
Just so you know, I sold one recently for a child going to the grandparents. It was $36 for the week.
Wow, nice.
It's not very expensive, and it's definitely worth having. You know, anytime Amy and I travel outside the country, we definitely get a travel plan, and it's definitely worth it. We've seen and heard too many stories of somebody on an excursion that gets hurt, they get injured, and then everybody's trying to pool money together to get them back on a flight to the United States so that they can get care. And it's like, you know, at least you have something to get you to that point. So, okay, ACA plans, max out of pocket. 8550 was last year. 8700 is now the max out of pocket 2022. So 8,700 is a lot of money. If people don't have $1,000 for emergencies, they certainly don't have $9,000 sitting around in their account waiting to pay a max out of pocket. And if it's a family, it's ×2. So that's a big hit to a family if they have something like that happen.
So that's one good example of why it's really, really, really important for you to package plans so that you're truly taking care of a family, even if their, you know, premiums are super low. Maybe they have a $150 budget, but they were able to get a plan for $25. That's great that you're saving them $125 out of their budget. But if those people go to use this plan, now they're financially in a wreck, and part of that's on you. At least you need to package it and explain it. And then if they don't want it or can't afford it and you need to take it out, that's one thing. But really, truly helping people on the front end on their premiums and on the back end when they really go to use their plan is really the winning ticket for them.
Absolutely. And then copays. Copays can be high. So there's copays on the marketplace that are $50 and $100 per visit. So sometimes that can be a problem for a family coming out of pocket that much money. Sometimes they're really low if they get a big subsidy, and maybe you do cost sharing with the silver level plan. You can get the copays down, but if you're on a bronze level plan, there's either no copays or they're pretty high.
Before you go on, I just wanted to touch on, so those are the holes and the negatives of the plan. The positives of the Affordable Care Act plans are they cover pre-existing conditions, ongoing medical conditions, maternity, mental health, you know, the free physicals or well checks, immunizations, any preventative stuff, all of those things. So there is good on, you know, really all plans, and there's negative on all plans. So I just tell people, look, the days of there being these perfect plans that cover everybody for everything, the deductibles are low, the copays are, you know, reasonable, all the doctors take it, you know, are just been gone for a while. So we just have to be real about how each of them work, the good and the bad of each, so that you they can align as you're educating them, align themselves with the plans that make sense and that gives them the peace of mind. And you're being real about the holes and you're telling them how we're filling them with our presentation. So just know that these plans are good. It's good that they're there. There's definitely people that need them. There's just no like one plan fits all kind of thing.
Absolutely. I'm trying to advance. There we go. Okay. Health shared ministry plans. So health shared ministry plans, we used when the Affordable Care Act first came out, and they were charging penalties if you didn't sign up for an Affordable Care Act plan. And health shared ministry plans were exempt from that penalty. So we would use these plans for people who are like, I don't want the Affordable Care Act. I don't want to go there for any reason. And they could go here, get an exemption, and they would still get decent coverage and not have to pay any penalties. The downfalls are that it's not insurance and they can't use insurance terms. So there's really no copays, deductibles, those kinds of terms. But sharing responsibilities can be high. They can start at $2,000 or $3,000 and work up from there into the tens and $12,000. But so can short-term medical plans as well. Copays can be high or none at all. And again, it's not insurance, so there's no guarantee that this plan is going to share when you need it. We've heard good stories. People don't have any problems with these plans, and then other stories where they went to have sharing, and the sharing was either extremely slow, where their bills were almost into collections or through collections before they got shared, or they didn't get shared at all because there was just no money to go around. And so there are stories on both sides of that.
Yep. So the health share plans, for us, when we've had a lot of people on them over the course of time, we've had quite a few claim issues, so that doesn't sit that well with me. To me, it's not rocket science, right? We pay our premium, we have a claim, you pay the claim, whatever carrier type of plan. I know insurance companies have to do due diligence to make sure it wasn't pre-existing and all of that kind of thing. But I really just don't like when our clients have a lot of issues with plans that we help to get them set up on. Now we do due diligence to help them and get into the midst of the claims process. And excuse me, I've filed letters of appeal. Most of the time they've gotten turned around, but it seems a little bit unnecessary. But the health share ministry plans, some of the good of them is they do have a nationwide PPO network. So that's improved from the marketplace. Some of them do have some copays. When you get up to the higher level plans, they'll have some, feel good benefits, I call them, that are similar to a group plan, maybe if they've been on that. And, that's just the conversation of how often do you go to the doctor? If they go to the doctor once or twice a year, probably doesn't really matter if they pay extra money for a $20 copay, because they're, going to pay several $100s more to save $40 when they go to the doctor. It doesn't mathematically make sense, but some people just have peace of mind with having a copay, and that's totally fine. That's why we're educating them about all the options. Another good thing about the health share ministry plans is that if they do have a what am I trying to say? An ongoing medical condition that is under maintenance. How I shared about my thyroid, blood pressure, cholesterol, things like that. They're on maintenance. They will cover those. They won't be viewed as pre-existing on a maintenance level. Now, if they were to end up in the hospital with that pre-existing condition, that likely won't be covered. So for me, when my thyroid started to become a problem, we didn't know what it was. We thought it was a heart condition, blah, blah, blah. If I had gotten a plan like this, when I ended up in the hospital and it ended up with surgery and different things like that, I wouldn't have had coverage for that. So this is where you have to do due diligence to ask the right questions when you're talking to people so that you know what their medical conditions are, if they're under maintenance, if they're new, if they're feeling like they've got some crazy stuff, getting ready to blow up. So just know that. And then they do have some coverage for maternity, which nothing besides group or the Affordable Care Act has maternity coverage, but theirs are just a set amount, like $5,000 usually for a routine labor and delivery. Well, if you've known anybody who's had a baby recently, that doesn't go that far. So 5,000 is great, but on a $50,000 bill. So, and then it's a higher level for C-sections and a higher level for, issues. What am I trying to say? NICU and complications and things like that. But again, 50,000 towards a $150,000 bill, so if somebody's going to have a baby, probably not the best option for them. I would go back to the ACA. So there's definitely some good things within health share ministry plans. And some people they don't want anything to do with any government plans, and they really align with the health share ministry mindset, and that's totally fine. So.
Absolutely. And then Tommy asked in the chat, so for healthy people with good to decent budget, look outside of the ACA first for network reasons. And yeah, that would be true for networks. You have usually nationwide PPO networks outside of the Affordable Care Act with most products. And so yes, you're going to have nationwide PPO networks outside of that. So yeah, that would be a true statement.
I would say of all the thousands of clients that we have, that it used to be maybe 10 to 15% of people were on an ACA or marketplace plan. I'd say now with the increase of the subsidies, probably 30 to 30%, maybe 35 are on a marketplace plan, and everybody else is on something else because they don't have the medical need to go to the marketplace, and or they don't get a big enough subsidy. And so the other plans just make more sense, so they can have the network and they don't have to deal with worrying about paying back a subsidy if their income changes and all that kind of stuff.
All right, short-term medical plans. So here you have a nationwide network, and you have to pass medical underwriting. So we have underwriting questions. You have a nationwide network. You have deductibles again to meet. Typically, short-term medical plans are going to start at $2,000 or $2,500 for the most part, and they're going to go up from there up to the $12,500 and even $15,000 range. So you can have a decent deductible or max out of pocket. We tend to use 100% coinsurance because it's easier to explain to clients. So what their clients will range from $2,000 to $7,500, maybe $10,000 on short-term medical plans, but our average is in that $5,000 range. So a $5,000 deductible, 100% coinsurance, meaning that $5,000 is also the max out of pocket for each member of the family. And pre-existing conditions are definitely not covered. Depends on what the conditions are, but you can, if you pass medical underwriting, you're good. Except they may exclude the particular ongoing thing that you have that they're okay with. Wellness visits, definitely not covered on most short-term medical plans. They are with some, but there's other products that we can add in a package that will help with wellness visits. It has term lengths, so they start on one day and they end on another day, just like a term life insurance policy. These, depending on the state, are 6, 12, 11 or 12-month terms. Most states you can get 12 months worth of coverage. It may be 2 6-month terms. It might be a 12-month term. Some you can get 2 years, some you can get 3 years worth of coverage out of it. If you qualify on the longer term lengths for the policy in the beginning, then you get you'll get the coordinating policies all the way through. So like on United Healthcare Tri-Term, it's a 3-year plan. If you qualify day one, then you have it all the way through the 3 years. So the thing to be careful with on term lengths, and this is what we do in our agency, is we want to make sure that anybody who has a term plan, if they are, if their term is ending in the middle of the year, we want to be very careful with that. If they have something go on at the end of a term, which keeps them from getting another term, and they end up in the end of June with no plan, they're waiting until January to get an ACA plan. So what we will do today, if somebody comes to me today, is I will write a short-term medical plan till the end of the year. And so we'll get them from today to December 31st or thereabouts. And then about a month or so prior to the end of the year, we're going to revisit that, and we're going to rewrite them starting January 1 for the longest term that we can get, 12 months, 2 years, 3 years, whatever it might be. And then we have them on an annual cycle. And we do that because if something happens during the end of their term, they will always coincide with open enrollment for under 65 ACA plans, and you can go right into an ACA plan. So there's no lapse in coverage, there's no gaps. They will go right into an ACA plan because they have to, or because they need it. So that's how we operate with short-term medical plans. So keep that in mind when you're writing these. You know, in the middle of the year, you want to get them to December 31st, and then you're going to write another plan for January 1 for at least a 12-month cycle. Yep, and that's pretty much it on short-term medical. Amy, do you want to expound on there?
Yep, and just a few things. So on pre-existing conditions, again, if it's something major going on, they take Humira that's $7,000 a month or something like that. Those again are your ACA clients. Pre-existing conditions, however, if they share with you, again, go back to my thyroid, it is under maintenance. I don't really care if my insurance company covers that condition or not, because I'm only going to my doctor once a year. I'm getting blood work done once or twice a year and picking up my prescription, which is, you know, 20 some dollars a month. I don't really care because I don't want to go over to the ACA and pay an extra, you know, $800 so that they cover my thyroid. I'm still going to have a copay for my prescriptions. I'm still going to, you know, have to pay part of my doctor visit anyway. So again, it's math. It's whatever the least annual out-of-pocket cost for what their normal usage of health insurance or healthcare is, right? So for me, that's really my only normal usage thing, you know, on my pre-existing or anything like that. So, so it makes sense. Now on the terms that Steve is talking about that have 2 or 3 year terms. So let's go to that United Healthcare Tri-Term plan. If I got that plan now, they would not cover my thyroid issue for the first 12 months, but after the 12 months, it is covered in term 2 and term 3. So now they'll start picking those things up. So that is a good thing for those plans for people that have some maintenance things, if they want to have them covered at some point. And then the wellness visit that he mentioned, we do have an ancillary product, a MEC product that you can add to the any of the to the term plan, basically to cover, you know, the free physicals and preventative and immunizations for the kiddos and things like that. Now, again, I go through that with them kind of really transparently and say, hey, look, this is just math. So if my normal annual preventative is X and Y, I can call my provider and ask how much that costs in cash pay. Maybe what if it costs $600, but to add that extra premium onto the plan costs me $1,100. Well, then it doesn't make sense to add the plan. It's not going to feel very good when I have to pay $600. But if we're educating them that this is the total picture of the year, then they know this stinks paying $600 now, but I know I'm way ahead for the year. Or if they find, well, they're paying $1,100 for the premium, but my out of pocket is going to be $3,500 for what I normally have done, then goodness, get the plan. So that's how we address the wellness visits. Most of the time, unless they're a family with little kids, babies that are going to the doctor every 3 months or every 6 months for their well checks, those people, a lot of times the extra plan will make sense. For most other people, they don't do that, but just know that there are options for that. What questions are there in the chat, Steve?
Ann asked, what do you do in states without short-term medical, Colorado, California?
Yep.
For example, some said travel insurance, but can we really do that?
What? Oh,
I
go
don't
ahead.
know that you can sell travel insurance to somebody who lives in this area that they're quote traveling in.
Mhm.
I don't know how ethical that is, but you know, in Colorado and California, they have their own state-based exchange. So you would have to use the exchange there, or they have fixed benefit plans that are available in those states. I mean, that's an option if someone wanted to look at a fixed benefit plan.
So what I do is I will shop, even if I'm not certified to do the marketplace in those states, I will still shop the plans for them with them and help them pick a marketplace plan if that is the best thing for them. I just educate everybody on what's available. So short term is not available. And I'm talking to a client in Colorado. I'm not even, I may mention that is an option in other states. It's not an option for you. And so I just want you to know, if you hear about it, it is good, but it's not available for you. So I do talk about the marketplace. Again, I know I don't really care if I'm not getting paid to help with the marketplace, on those few clients. I know it sounds silly, but you're going to package those plans. You're going to, still help them overall. You're still going to make some commission off of that. But I do educate them about the health share ministry plans. I have people in those states on health share ministry plans, and they like them. They're working for them. They're better than what they could get on the marketplace in terms of premium. And then I have had a few people opt for the fixed benefit options. Now, I'm not a huge fan of those. I will never sell one of those by themselves. If someone wants something like that, then I have a well-known carrier like United Healthcare. We pick the most robust plan and package it like crazy with the biggest accident plan benefit you can get, which is usually about 20,000, that will add benefit on top of the fixed benefit, and then a big old critical illness policy, all the things, right? So now, I will say, of all those people that have those kind of plans, they love their plans. They love it. And I've not had any problems with them. So those are the solutions that we offer just because they are available. But again, we go through the same pros and cons, pros and cons, pros and cons. This is how we fix the cons if we can. Really, the only con we can't fix is the marketplace's network, other than, like Ann said, to provide a travel plan or something like that. So
when Amy was talking about Colorado and California, we have a one-off client here or there, and that's why we will help them in those states with the medical piece on their marketplace, state-based marketplace, and we won't get paid for that. But if we do the marketplace or the state-based exchange certification, then you can get paid on those products. So if you're marketing in California or you're marketing in Colorado, then you can get paid on those policies. You just have to do the state-based exchange certification. And then,
or you can send them to Ann and she can write them.
Ann can write them. That's right. Okay. And then Robin said, if someone on a short-term medical plan, they get a job that has benefits in July, but it's a 12-month plan, can they cancel mid-year? Yes, you can cancel it at any point. The only caveat to that is if they're in the middle, let's say it's July 5th and they want to cancel, let's just say July 4th. you want to cancel on July 4th, then you've already paid for the month of July, then you have coverage through the month of July. It would stop at the end of July. So July 31st would be the end date, and then premiums would stop after that.
Yeah, they go month by month. They don't prorate. So just know that. And that's a great question. I always tell people, look, if you lock into 1 year, 2 year, 3 years, whatever it is, that is just, you get to lock into the plan. The carrier cannot cancel you for any reason except for due to non-payment. But you can get out of the plan at any time. So.
All right, fixed benefit plans. So fixed benefit plans, again, will have a nationwide PPO network. They pay on $1, so there's no deductible to meet first. So they will pay right away. Some of the holes are they pay what it pays what it pays, and it doesn't, there's no more, no less, right? If it pays $50 for a doctor's visit, it pays $50 for a doctor's visit, and that's it. So there's no max out of pocket, which can be a problem. There's no stop loss on this plan. So it's going to pay what it pays. It won't pay any more. And it's better served as an ancillary to an ACA or a short-term medical plan. So like Amy said, she will either package this thing to the ceiling, or it's going to be paired with a short-term medical plan or an ACA plan. So again, this would be like putting a hospital indemnity plan to a MAPD plan, right? That's how that would probably work, or the analogy how that would go.
Yeah, so in the states that have term plans, you can choose a higher deductible term plan, maybe 10,000, and stick a fixed benefit plan in there. It's basically going to pay all their out-of-pocket costs. And if you can, like again, just United Healthcare, if they have their own plan, so does National General, Allstate. So it's ideal if you can use the same carrier, because they can just coordinate benefits within themselves. However, we've used Manhattan Life, has a really great fixed benefit plan that I love. So it's just educating them on how to utilize those plans when claims come. I always tell them to use the term plan, their ID card, to get the in-network discount from Allstate or United Healthcare or whoever, and then they can submit the claim. Now the provider can also submit the claim for Manhattan Life, for example. I prefer to just do it because myself, or our own coverage, because they're going to pay me directly. And sometimes that, like Steve said, they pay $75 for a doctor visit. Well, if mine only charges $50, then shoot, I can go to lunch for free, right? And sometimes when they're coordinating the benefits that way with maybe a larger claim, sometimes people make, you make money. Like, so if the claim was $3,000, the carrier may end up paying $3,500 for that. So, I'm not saying, I tell people now, don't look at this as an income producing solution and go out and try to, hurt yourself or cause a claim or something. But it does work really well. Now, obviously, when you're adding extra plans together, the premium is going to be a little more, so they have to have room in their budget for it. But a lot of people really like that, higher deductible with the fixed benefit plan tied together.
Mm-hmm.
I think I saw another question pop in. Can you read?
Robin put in there, can you give some examples of fixed benefit plans? So you mentioned Manhattan Life. That's the affordable choice plan. And there's different levels of these plans. So they pay, where we look at fixed benefit plans is the hospital confinement. When you're confined to a hospital, how much do they pay when you're admitted? And how much do they pay per day while you're in the hospital? And does that equal or mostly pay for what somebody would have an overnight stay in the hospital for? And so they have the least amount of money out of pocket when they go use it, but then that's going to raise the premium too. So United Healthcare also has Health Protector Guard, which is also a fixed benefit plan. They're going to work very similarly between those two carriers. And but the benefits, so United Healthcare may have 5 or 6 different levels. Manhattan Life's going to have 3 or 4, and you're just going to need to select the benefit level that you think is best for that client. Now, the lesser, like level 1 and 2, probably we've never sold. 3, 4, and 5, we're probably that's right in the wheelhouse. And then anything above that could be too much coverage, or maybe that's what they actually need. So somewhere right in the middle, to the higher benefit level plans is where we end up most times. So like a $5,000 hospital confinement, kind of 3,000 to 5,000. That's kind of what we're looking at in most cases.
Yeah, because those basic ones are like $300. Well, I mean, you know, they probably charge you $300 for an aspirin, you know.
Yeah.
So it doesn't do a whole lot. And then the ones on Clear on the other end are usually just pretty expensive. So it's marrying the middle ones with the budget.
So the 3 that we've used the most are Manhattan Life Affordable Choice, United Healthcare Health Protector Guard, and then the National General fixed benefit plans. Those are probably the 3 that we are most familiar with and have used the most. So I can tell you that we haven't had too many or any really issues with United Healthcare or Manhattan Life with those plans. They're pretty solid.
As far as claim issues, we just haven't had any. There's had quite a few claim issues with National General or now Allstate, but you know, it's good to still have them in your back pocket because there are some markets like Kansas that don't have many carriers that have a 12-month term plan. So we have to have National General or Allstate in our back pocket and utilize them. Just know we're probably going to have some more customer service with those clients when they have claim issues or claims, because there likely will be issues, not all the time, but just much more so than United or Manhattan Life.
Absolutely. All right, fill in holes. So wellness visits, accidents, critical illness, hospital stays, dental, vision, hearing, life insurance. Those are the basic things that we add to a package plan to fill these holes, fill these gaps. On the critical illness side, it's like cancer, heart attack, and stroke, and that's exactly how we explain it to clients. Cancer, heart attack, and stroke, things like that, even though it might cover loss of eyesight, burns, paralysis, those kinds of things. Products we use: accident medical expense, like United Healthcare Accident ProGuard, Life Secure if they have kiddos that play sports, because Life Secure will cover intercollegiate and interscholastic sports and practices for those events. So Life Secure will cover that, where most other AMEs do not cover sports like that. Critical illness.
On the accident, I just want to say something real quick. You'll see when you're out quoting that there's AME, accident medical expense, and then there's like a accident fixed benefit. So the fixed benefit accident plan is going to pay X amount. It's kind of like Aflac, X amount for X-ray, X amount for diagnostic other diagnostic tests, and a certain amount for the doctor visit, blah, blah, blah. I like to use the AME because the AME is a lump sum. So if we have a $5,000 deductible, then I want to marry at least a $5,000 accident plan with that. It'll cover the deductible completely except for $250. So if you go back and watch the training we did on our presentation, how we explain the coverage, we're going through the deductibles and the copays and blah, blah, blah. We get to, hey, if anybody gets hurt or injured, your max out of pocket is $250. And then I give an example. And so you can just use that same presentation as an example. Then people are understanding like, wow, that would have been great because little Johnny, fell out of a tree last year and broke his arm, and it cost us, $5,000 or whatever it is. So
Okay.
make
Now-
sure you use the AME, not the indemnity one.
Right here under where it says products we use, AME, critical illness, DVH, life. This is the basic package setup that we use. And then the medical piece is right above that. So on the medical piece, that can be interchangeable, right? So you can keep this package in play for the long haul and then just swap out the medical piece as needed. So let's say they start with a short-term medical plan and something goes wrong and this thing ends in December 31st and they need an ACA plan in January, then we just swap that piece out for an ACA plan and go. And the reason I'm telling you this is on the AME, a lot of us will like to match the AME to the max out of pocket of the medical piece. And you might do a short-term medical plan. Let's say it's $5,000 max out of pocket, and you give them a $5,000 AME, and then they go to an ACA plan in January, and their max out of pocket is $8,700. So now you have an AME that pays $5,000, and you have a max out of pocket that's $8,700. So now there's a gap, right? And they're either going to come out of pocket, or we're going to change the AME. So what I do personally, if budget allows, and it's not going to hurt anybody, I will put a $10,000 accident medical expense on everybody. And that will cover any interchangeable medical piece unless you go to a short-term medical plan above $10,000. So typically, if you're going to go to 12.5 or 15,000, then they're going to pay that out of pocket, because there are some AMEs that will go up to 20. We would just have to make sure that we're selecting 20 on the AME to match that piece. But most people are going to be 10,000 or less. And so I will just add a 10,000 AME directly to every plan. That way we can interchange the medical piece and never have to worry about the AME. It's always in place. So that's the rest of this package right here. Let's see, question in the chat. Where are the recordings for previous training sessions? That would be on your Secure Insurance Group agent portal. It'll be on the agent portal. I think it's on the Facebook page and maybe somewhere else. We're probably going to put those on our website as well. So we'll have those there in the future. Okay, exposure. This is why we package. $6,000 deductible per person, 60/40 co-insurance to $8,500, max out of pocket per person times 2 for a family is $17,000. That right there is a lot of exposure to a family, right? So if we're talking about a family of 4, $17,000, that's a lot of money. And if they don't have $1,000 for an emergency, how are they going to pay 17? How are they going to pay 8,500, right? So this is why we package. We package those to make sure that those numbers disappear in the event of an injury. So in this case, we have a family of 4 with $150,000 income, and they get a tax credit of $965. So their premium was 2014. Now it's $1,049. And we're going to go see how we put this thing together. Oh, by the way, if you have a Medicare spouse, this is your commission on an ACA packaged Medicare spouse. That's an annual commission, so not too shabby. All right, fill in this hole for a family of 4. There's your max out of pocket, $8,500, AME, $5,000. Cancer, heart attack, and stroke, $30,000. And I like cancer, heart attack, and stroke as 3 times the max out of pocket is typically the minimum for me. DVH premium $1394.51, and this is after a subsidy, right? So now you take the AME and the cancer, heart attack, and stroke, and you can cancel out that $8,500. It's going to pay, well, in this case, it's going to pay $5,000 of the $8,500. So this is kind of going against what I just said. But you know, so if this is $10,000, then that cancels that guy out. Cancer, heart attack, and stroke, if it was that, then you have a critical illness benefit coming in, lump sum $30K. You take that, you pay the $8,500, and you move on. Okay, so their AME deductible is $250 pay that. They get the $5,000, goes right towards the max out of pocket. And on critical illness, it's zero. So you get the lump sum and you directly pay the provider. You save the family $639.49 per month and fill the holes from the ACA plan. Now we're keeping more money in the client's pocket, less money in the provider and insurance company's pocket. Right? And you doubled your commission. Okay, commission for this family of 4 packaged on the ACA. So that scenario we just went through, this is commission on a packaged ACA plan. All right, let's go to short-term medical. Let's use the same family of 4. We're using United Healthcare short-term medical plus elite, 12-month plan, $5,000 out of pocket. 5K AME, so that cancels that out. 30K cancer, heart attack, and stroke or critical illness. DVH for $3,000. And now we got a premium of $1134.01. Again, AME and critical illness cancels out the max out of pocket. They pay $250 for any injury. They pay $0 for critical illness. They just take it out of their $30,000, pay that off, that $5,000. Save the family $879.99 per month over the ACA plan, and you filled the holes in their short-term medical plan. Now we're still keeping more money in their pocket, right? And we've doubled our commission. And on this kind of a plan, your commission is more like this. So if you find people that fit short-term medical plans and you can package them properly, that's a nice payday on a family of 4 for the year.
Hold up. I thought there was no money to be made in under 65 health insurance.
That's the myth, right? The myth is that there's no money to be made here.
Even
So-
on the marketplace package plans, there you can make a good income. So
Yeah, for
for
sure.
all the people that feel sorry for you doing under 65, just tell them, I know. I'll be happy to take your referrals and handle them for you.
Yeah,
Or you can help them become part of your team and you can all win.
absolutely. All right. Any questions on anything that we went over here? You can put it in the chat. You can unmute, whatever you'd like to do. Was that helpful? Thumbs up, good? No?
Yeah, when can I schedule to come up to Kansas City and shadow?
Anytime you want.
Anytime, reach out. We'll set up our schedule with yours.
Are you serious? Would you
Yeah.
do that?
Oh, yeah.
I'll clear my
course.
calendar for you.
Yeah. We've had several people do that. Will Atchison flew up from Florida and spent a couple days. So
Absolutely.
Righteous. Well, when my condition improves, I'll do it.
Yeah. And Dennis is so far away. I don't know if he could make it all the way over here, but he's just down the street in Blue Springs, so he can come by anytime.
May take you up on that sooner than later. I literally just completed the marketplace training yesterday and it was tedious as all get out.
Yeah.
I'm in Arkansas. Any suggested carriers just get going with?
I think the main ones that we've mentioned before, United Healthcare, National
who's in
General.
Arkansas?
What's that?
I haven't sold anything in Arkansas in a while.
I have.
I can take a look at the carriers and give you some recommendations there, but Ambetter is probably one that I would look at. United Healthcare, Aetna, if they're in the market. You use the big name guys like that. If there's a blue, you probably want a blue because everybody asks for blue, whether you like them or not. But I'd have to look at the list of carriers in Arkansas, and I can tell you. What's the zip code in Arkansas?
72034.
I can tell you right now, right quick. 72034. Okay, we have Ambetter, Arkansas Blue Cross, HMO Partners, Inc., Oscar, QCA Health Plan, Qual Choice Life Health and Insurance Company. So in that case, you're probably looking at Ambetter, Arkansas Blue, Oscar, those three at least. And then we have to see about the others if they contract independent brokers or not.
Okay, thank you.
Absolutely. Anybody who wants to come up and shadow us at any point, or just come up and, ask questions and, do a little in-house training, by all means, we're game.
All right,
Anybody-
guys, well, let us know any questions you have anytime, call, email, text. We're here to help. Not just training, but support, or you're like, holy smokes, I just talked to somebody and there's this thing, what do I do now? We usually try to help people through the first handful of sales. We don't take the sales. They're your clients, your commission, your whatever, everything. But that usually gets people, through the normal process. And then if you're like, there's always something weird that pops up here and there. Even for us, sometimes we're like, shoot, what do you do with this again? So just reach out and we probably experienced most of the weird stuff, but if not, we'll learn together. So
Outside of referrals, how are you getting in front of people?
How are we getting in front of people?
Yeah.
So with under 65, we do a lot of referral partners. We do a lot of, we ask all of our clients for referrals. Anybody that we help, anybody that we don't help, we ask for referrals. There's under 65 leads that you can purchase. So we've done a lot of lead purchasing in the beginning, and then not so much after we get a bunch of referrals coming in. So we've done that. And then on the marketplace, you can register with their help desk. They have a help desk certification. And when you register for the help desk, they will find somebody in your area that is looking for help. Maybe they started an application and they don't know how to complete it themselves, but they don't want to call the marketplace. They're looking for an agent to come help them. And then they will put that into a system. And if you're one of the agents in their area, they will pull you up and they'll send out an email. Sometimes it's a text to your phone, or it can be both. And you have like 15 minutes to respond. If you respond, if you're at your desk and you respond within that 15 minutes, they send you the lead, then you call them and you try to help them out. If you help them, you put your NPN number on the application, then you get paid. So there's a number of ways to find those. I would say in coming days, I would definitely do the help desk with the marketplace. And if you have scheduled hours in front of your computer, then I would just keep that website up and I would just monitor your email or your texts. And when those come in, I would just jump on them, because that's easy money right there.
the clients will also see a list of agents, and they will sometimes just they may pick you and they'll call you, or they'll send you an email. Before I forget my train of thought, so hold on to yours, Robin, is I think about the QLEs, right? I think about, because those qualifying life events that happen all year long, those people have access to the marketplace within 30 days of a qualifying life event. So anybody that's getting married, anybody that's going through a divorce, because someone is losing coverage, one of the two is losing coverage every time. So, so like in that, think of divorce attorneys. They're a great referral source because they don't usually know. When I was going through mine, my attorney's like, I don't know, maybe just Google like Blue Cross or something. I'm like, thanks for the help. So if you can, form some friendships and relationships with divorce attorneys, that's a great one. Or, back to the getting married, maybe premarital counselors or wedding planners or those things, because people are, excited about all the fun stuff, but they sometimes forget the boring but important stuff that's much more lasting than the ceremony, like insurance, having a baby, moving to a new zip code. So there, make referral partners with realtors, mortgage lenders. They all know people moving all the time, right? So that's where you get a lot of people that you can help. Your PNC agent, usually when clients are like, if they're leaving their employer, they don't want to do Cobra because it's so expensive. Marketplace they get on sometimes is confusing, or they just don't know. They call their PNC agent, hey, can you help me with health insurance? And they're like, I can, but I don't want to. I don't do that. So call Amy or Tommy or Robin or whoever, So that's been a great referral source for us over the years, and financial planners as well. Okay, Robin, go.
Steve, you mentioned about the help on demand, and then you specifically said over the next few days. What's going on in the next few days that would increase the frequency of them reaching out to you?
I just mean like in coming days and coming, this year, next year, you're going to see more and more traffic through places like that, especially when you get to open enrollment. And I know that, if we're writing a lot of Medicare, we're going to have AEP, we're going to have OEP overlapping. Those open enrollment and AEP are going to overlap. And so I'm going to take care of my Medicare clients, my current Medicare clients, do reviews. Like that's the first thing I'm going to do. October 1, boom, I'm starting to do reviews, and I'm going to get everybody through as quickly as I can. And then any new clients that are coming in, I'm going to mix them onto my calendar. And then I'm going to hit the open enrollment period towards the end of open enrollment. I'm just going to, as soon as I handle most of my Medicare stuff, I'm going to go straight into open enrollment, and I'm going to just start, hitting everybody there. So I'm going to set my calendar up in kind of two pieces, and then eventually it's just going to merge together, but I'm going to try to keep them as separate as I can. So I'm doing all Medicare and then all open enrollment under 65 after that. And that's what I'm doing now. And when I get to the point where I have somebody helping me or assisting me through that, then that'll be much easier. We can do the reviews, and somebody else can update applications and select plans. And that will be very helpful. So
Tommy, that's another good referral source, is if you do, and I don't know if you do, but if you're a Medicare agent, then the spouse, right, typically is also not turning 65 on the same day, as their spouse. So you need to be able to help them, especially if that spouse is wanting to retire. We don't want to feel like they have to keep working so that their spouse can have coverage. We can help them with that. So that's another good one.
I can't tell you, since I've been writing more and more Medicare, where I have the ability to help both sides in that scenario. You can help the under 65 spouse, and you can help the turning 65 or the over 65 coming off of a group plan. It's awesome. You can work both sides of that, and then sometimes you can get them coming off of a group plan early, and they're in 63, 64, and you can help them on the under 65 market until they turn 65, and then now you have two new Medicare clients in another year or so coming in. So it's been awesome to have both of these things working at the same time. So
cool.
I'm going to jump off of here, and while you finish up questions, we have another training we have to lead, so I'm going to go get that one started. So thank you guys. I'll see you soon. Bye.
Thank you.
any other questions from anybody while we're still here?
Not from me.
All right. All right, guys. Well, we thank you very much. Hopefully you got something out of this. This will be recorded so we can go back and review it again. And we will be coming out with Friday, tomorrow. We're going to come out with some more material at 1 o'clock again. And it's going to be a different, we're going to keep putting these pieces together. It's going to include commissions. It's going to include products. We're going to get into some knowledge and different products that we use, how we quote it. I know I briefly touched on that before, but we're gonna keep going through this and help walk you guys through under 65 as much as you want to know, and we'll keep it going.